Hey everyone, welcome back to the FluxFolio Finance Channel, your go-to source for unpacking the biggest financial stories impacting the global economy. Today we're diving into a topic that's been making waves in the financial world, the basis trade. You might have heard this term thrown around lately, especially with all the chaos in the US Treasury market and the ongoing trade war. We're going to break down what the basis trade is, how it works with treasuries, and why it's posing a serious threat to both the US and global economies. Let's get started and uncover the risks hiding in plain sight. First, let's define the basis trade. At its core, a basis trade is a strategy where traders try to profit from the price difference, or the basis between a spot asset and its related derivative, usually a futures contract. In the context of US Treasuries, which we've been talking about a lot lately, this means the difference between the price of a Treasury bond in the cash market and the price of a Treasury futures contract. The idea is simple: if the two prices are out of sync, traders can buy one and sell the other, betting they'll converge over time and pocketing the difference. Sounds straightforward, right? But here's where it gets complicated and risky. Let's walk through how a basis trade works with US Treasuries. Imagine a trader buys a 10-year Treasury bond in the cash market for $100. At the same time, they sell a Treasury futures contract tied to that bond for $101. That $1 difference is the basis. The futures contract is an agreement to deliver a Treasury bond at a set price on a future date, and in theory, the futures price should reflect the cash price plus the cost of holding the bond, like financing costs, until that date. But market inefficiencies, like supply-demand imbalances or hedging activity, can cause this basis to widen or narrow. The trader's goal is for the basis to shrink. Say, the bond price rises to $100.50 and the futures price adjusts to $100.70, making the basis just 20 cents. They'd make a 80-cent profit per bond, minus costs, by delivering the bond against the futures contract. Here's the catch: to make this trade worthwhile, traders often use a lot of leverage. They borrow heavily through the repo market, where they lend the Treasury bond as collateral to borrow cash at low rates, around 4% to 5% in 2025. This lets them control huge positions with little capital. For example, with $1 million of their own money, they might control $10 million in treasuries. While they hold the bond, they earn its yield, say, 4.59% on a 10-year treasury as of April 2025, but pay the repo rate, pocketing the difference, or the carry. This carry can add to profits, but if the basis moves the wrong way, those leveraged positions can lead to big losses fast. So why is this a problem for the US economy? Let's start with the scale. As of early 2025, the Commodity Futures Trading Commission reported that hedge funds and asset managers held Treasury futures positions worth $800 billion, many tied to basis trades. That's a small fraction of the $36 trillion Treasury market, but the leverage, often 10 to 1 or higher, means a small price move can have a massive impact. If something goes wrong, like a sudden drop in Treasury prices, traders might face margin calls, forcing them to sell their bonds and buy back their futures contracts at a loss. This is called an unwind, and it can happen fast. We saw this in April 2025. Reuters noted on April 11 that hedge funds were unwinding basis trades, adding to volatility in the Treasury market as prices swung wildly. That volatility is a big deal because the US Treasury market is the backbone of the financial system. Treasuries are used to price everything from mortgages to corporate loans. When prices drop, yields rise, like the 10-year Treasury yield hitting 4.59% in April 2025, and that means higher borrowing costs for the US government, which is already dealing with $36 trillion in debt. Higher yields also hit businesses, as loan rates go up, slowing down investment, hiring, and economic growth. Plus, $3 trillion of treasuries are maturing this year, including $147 billion in June, so the US needs to refinance at these higher rates, putting more strain on the budget. If basis trades amplify this volatility, it could make borrowing even more expensive, slowing the US economy at a time when it's already under pressure from the trade war. The trade war adds another layer of risk. With Japan and China selling treasuries, Japan offloaded $47 billion by February 2025, and China sold $50 billion, there's already downward pressure on prices. The US has slapped tariffs on over 75 countries, including a 10% rate on Japan and a 25% duty on Japanese cars, which has led to market uncertainty. If basis trades unwind amid this selling, it creates a feedback loop: falling treasury prices, rising yields, and more forced selling. This could erode confidence in treasuries as a safe haven asset, which is a huge problem because the US relies on that status to borrow cheaply and print money without immediate consequences. If confidence fades, the dollar's role as the world's reserve currency could be at risk, shaking the foundation of the US economy. Now, let's zoom out to the global economy. The Treasury market doesn't just affect the US, it's a global benchmark. If US yields spike due to a basis trade unwind, borrowing costs rise worldwide, especially for emerging markets with dollar-denominated debt. That could lead to defaults, like we saw in the 1998 Asian financial crisis. A stronger dollar, which might happen if the US prints money to stabilize markets, would hurt export-driven economies like China and the EU, worsening trade war tensions. Global banks and funds holding treasuries would also take a hit, potentially triggering a broader financial crisis. The $800 billion in basis trade positions might seem small, but the leverage makes it a ticking time bomb, especially with the trade war already creating uncertainty. Who's behind these basis trades? Mostly US-based hedge funds like Citadel and Millennium, which have the expertise and access to the repo market to pull off these strategies. European funds are involved too, but US players dominate because of their proximity to the Treasury market. Japan and China, despite holding $1.079 trillion and $784 billion in treasuries respectively, are more focused on selling outright rather than basis trades, though some private funds in those countries might participate. The real danger isn't who's doing it, it's how much leverage they're using and how interconnected the Treasury market is to everything else. So, how bad could this get? In a worst-case scenario, a mass unwind of basis trades could spark a liquidity crisis in the Treasury market, similar to the repo market squeeze in 2019. The Federal Reserve might have to step in, like it did in 2020, buying $360 billion in treasuries to stabilize things, but that risks fueling inflation, especially with so much debt maturing this year. Globally, the ripple effects could slow growth, destabilize financial systems, and deepen the trade war divide. The basis trade isn't going to collapse the economy on its own, but it's an accelerant, like pouring fuel on a fire that's already burning with trade tensions and market uncertainty. That's the basis trade in a nutshell, a strategy meant to exploit small price differences that's now a big risk because of leverage and market conditions. Thanks for tuning in to FluxFolio Finance Channel. Hit that thumbs up, subscribe, and ring the bell for more deep dives like this. Drop your thoughts below. What do you think about the basis trades risks? We'll see you in the next video.